I view inflation a little bit differently than the way a lot of people do. I kind of look at inflation like a tax. We'll talk about why and go through a bunch of examples later on in the presentation. But first off, let's just cover the question of what is inflation. Inflation is basically the general rise in prices over time. You probably remember, hey, it used to only cost me 10 cents to get this can of soda or whatever, and now it's $1. Through time, that is looked at as economists, and it has the name of inflation. But before we really get into the nuts and bolts of what to do about inflation and how to handle it, I actually want to back up and talk about the definition of money, because this is where I think the more you understand money, what money is, what wealth is, the better decisions you're going to be able to make going forward. I view wealth or money as purchasing power. So I have no definitions of currencies or US dollars or gold or any of that type of stuff. Money is just a placeholder for things that I could buy with that money. So for example, let's say, hypothetically, of course, that one of my favorite things to buy in the entire world is ribeye. Okay. Which Eric knows, and some of the other people know that are probably watching this right now. I like my steaks. So we're going to say right now that a ribeye costs $10. If I make $100 investment, this can be in any vehicle. Okay, it could be a stock, a bond, a rental property, whatever it may be. If I invest $100, I'm giving up 10 ribeyes today. That's how I look at it. So to me, the thing that I value is the ribeye. I'm giving up 10 ribeyes today. Let's say I'm gonna invest over the next 5 years. Let's say the price of ribeyes is going to double over the next 5 years. So a steak that used to cost me $10 now 5 years from now costs me $20. That $100 that I invested needs to be worth at least $200. Otherwise, what happened? Well, I lost ribeyes. Which to me, that's a tragedy. But even if it grew from $100 to $180, I can now only buy 9 ribeyes. What this means at the end of the day is I lost wealth. So even though a lot of economists and people in the news and stuff, they're going to talk about inflation in positive terms, the general long-term trend of rising prices, and they're going to show you graphs like this, which this is actually the price of the average good, all urban consumers going back to like 1950, and you'll see it's a graph going up and to the right. A lot of people look at this and go, that's a good thing, right? And I would say not so fast. So I view inflation very negatively. So if you go back and look at the stats, in 1950, a new house cost $7,400. Think about that. Think about what you could get for $7,400 now. What's that, like 6 months rent in an apartment? Okay. So I view inflation as the general long-term trend of the dollar losing purchasing power. Inflation is long-term loss. And I view inflation like this. The item today, that the same item that I can buy today costs 26 times more than it cost me back in the early 1900s. Okay, and this is crazy to look at, right? Like this is the value of the United States dollar through time, and this is from the Bureau of Labor Statistics. And literally, it used to be that a dollar could buy you 25, 26 times more than it can buy you right now. So I'm not going to get into the real weeds on this stuff and the mechanisms for like how the Federal Reserve works, how government deficits work, and different things like that. But I do want you to know where inflation comes from, because to me, that's really important, especially in this environment, right? Where we see, this is from a couple of days ago or maybe last week, import prices jumped 1.2% in March, add to rising US inflation. I don't know if anybody on this webinar has tried to buy like lumber or anything soon. Or recently, I should say. I have a bunch of cedar laying in my garage right now that's going to turn into a play set this weekend for the girls. And that stuff is a fortune right now. Like, wood is out of control. And that's not the only thing. It's happening across a lot of different commodities. We're seeing it in oil, we're seeing it in a lot of different places. But the thing to keep in mind here is that we can look all the way back through history, and you can see inflation going all the way back on this graph. We can track inflation all the way back to 1914. Okay, the reason we don't want to track prior to that is because prior to that, it was a really boring graph, because basically the dollar was fixed to gold, and things things kind of just looked like this. And actually, for a long period of time, there was a very light level of deflation in the economy. Like things became cheaper as technology improved. 1913, creation of the Federal Reserve, creation of the income tax. Look what happened to inflation on the left side of this graph. Inflation popped up to 15, 20% a year. Then, of course, that big drop right there, that red line in the 1920, 1921, that's getting into like Spanish flu and that whole pandemic. And keep fast forwarding through time. Look at how many times we've been above 10% inflation. This is not some third world banana republic. This is the United States in the 20th century was at 10, 15, 20% inflation numerous times. Through the 70s, most of the 70s and 80s and early 80s, I should say, we were above 5% inflation. Where we're at right now on the inflation scale, historically, even though it seems high, really, really low relative to where we've been in the past. And where does inflation come from? So a lot of economists, if you talk to them and say, hey, where does inflation come from? They're going to tell you that it's a mix of an increased demand for goods and a decreased supply of goods. So they're going to tell you things like, as we're mining materials, we have to go further and further down, and it gets harder and harder to get them out of the ground. And that generally puts upward pressure on prices throughout the rest of the economy. And as there's more people, there's more demand. And I'm going to call hogwash on all of that. The place where inflation comes from is an increased supply of money. Okay, so when you go back and you look at things like the Federal Reserve's balance sheet or spending and deficits by the United States federal government, that is far more predictive of inflation than any kind of vague supply demand in the economy thing. And just to kind of put this in perspective right now, why are we starting to see inflation pick up? The national debt, $28 trillion. Look at the line right below that. This is from usdebtclock.org. U.S. federal spending, $6.7 trillion. Over on the right there, it says what they're actually, they're spending 3.2 trillion more than they're getting in tax revenue. So what happens when the government's just pumping an extra 3 trillion a year out into the economy? Well, if there's 3 trillion more of something, that something probably is becoming worth less and less over time. Like if we injected 3 trillion Beanie Babies into the marketplace, it probably crashes the price of Beanie Babies, right? Well, in this case, we're not talking about Beanie Babies, we're talking about dollars. And we're talking about a general weakening of the dollar as the federal government is spending a lot of money. Dollars become more plentiful, there's an oversupply of dollars, and there's downward pressure on purchasing power. And we are way ahead of any projections we've ever had as far as how much debt we would have. This is a really interesting graph coming into COVID, where this the dotted line there shows where we were going to go, relative. So this, I should back up. This is debt as a share of GDP. So this is the amount of debt in the United States versus the size of the economy. And what you'll actually notice is right now we've popped up above 100%. So the amount of debt outstanding is actually bigger than the size of the economy. And the last time we did that was right after World War II. And I want to go back here just for a quick second, if this will let me. I should have probably called this out with a little bit of a highlight, but what you'll kind of notice at the end of World War II is inflation really quickly goes from like 3 and 4% a year up to 15, 18, 20% a year. Okay, so I'm not trying to make a prediction. I don't know that that's going to happen. I think the world is a lot different now than it was then. But just be aware, when we've seen this much spending this quickly, when we've seen the debt as a percentage of GDP basically hockey stick up like it is right now, that's usually been followed by a lot of inflation. It's just a matter of there's a lot more dollars floating around out there than there used to be. The Federal Reserve, they've pumped an extra 3 trillion on top of what the government's put into the economy. This shows the balance sheet of the Federal Reserve. It's gone from $4 trillion prior to COVID to now above $7 trillion. So that literally means 3 trillion more dollars got pumped into the banking system. Those banks go out and make loans against that. So the actual net impact on the economy is much larger than that 3 trillion because of all the loans that are getting created. So I know I'm going kind of quick here, but the bottom line takeaway up to this point, inflation comes from oversupply of money. Inflation comes from a lot of dollars in the system, which is very easy to track. So when you see these headlines that are all about like the White House and the Federal Reserve, they're monitoring inflation. It's kind of like an arsonist monitoring a fire. It's just like, what do you need to monitor? Like you, you tell us what your inflation target is, and we know where inflation's going because you guys are the ones pumping the money out into the system. So it's really interesting to me. This is not some sort of weird phenomenon. Like when you see inflation, that is not a natural thing. That is a man-made thing. And I'm happy to debate someone on this if they want to. I'm not looking at the comments on purpose because we got a ton that I want to get to here. So what I want to do, rather than focus on where it comes from and the history and all that type of thing, I want to really drill down into what it means for you. What does it mean to the person that's retired or the person that plans on retiring soon? And when we run retirement plans for people, we do this every day. And one of the things we do is stress test. And we like to look at a lot of different things. So we run your retirement plan through 1,000 different scenarios. Some of them are really good markets. Some of them are really bad markets. They're all over the place, but also inflation rates are all over the place. We run high inflation, low inflation, tax changes, all sorts of different things. And then we show you, hey, this is how your plan holds up under all these different scenarios. So this is someone that we just ran a plan for. They were in the high 90s. I believe they were at like 99% probability of success, which means 99% chance that we expect them to have money left over at life expectancy. Very solid, very strong plan. And then we ran all these tests. So here's some of the tests. Bottom left here, we see a stock market crash like 2008. They moved from a 99% to a 97%. So their plan is very unlinked from the market. That's good. Number two, kind of in the upper left, we're going to kind of go around clockwise on here. So 1% lower returns, that moves them from a 99 to a 92. So if your money doesn't grow quite as fast as we think, hurts you a little bit. What about a cut to Social Security? So I believe we ran a 15% Social Security cut in this situation. They moved from a 99% to a 91%. And then long-term care. If either one of these two people needed to go into a long-term care facility, they were going to move from a 99 to a 92% probability of success. So mild impacts, right? Kind of 5, 6, 7, 8% impacts on these different things. Look what happens when we look at inflation. Okay. If inflation goes up by 1%, your probability of success cuts in half. Okay, so when people are lying awake at night going, man, what if they cut Social Security? What if we see a market crash? What if I need long-term care? The thing that keeps me awake at night when I actually get to sleep because Harper's asleep and everyone's down, I'm actually thinking about inflation. I think about inflation way more than I should. And it's for this reason right here. I know how devastating it can be, especially if, you're on a fixed income, if you're on a pension, and that pension maybe is not able to adjust and keep up with inflation. It doesn't take much in the way of inflation to absolutely devastate a retirement plan. So this is why this matters to the average retiree. Is usually it's one of the most dangerous things that we test in a plan is just a little bit of inflation. And I believe all investments, every investment you ever look at should be judged net of inflation, after taxes. That's all we care about. That's the only thing that matters. And there we go. All right. It froze up for me. I hit the button and it didn't go. But to prove this point, I want to ask a question. So everyone that's on this webinar right now, feel free to answer this in the comments. How would you feel about a 100% income tax rate? And please keep it at least like PG. Don't be dropping F-bombs in the comments. but how would you feel about that? So you earn $100, the government charges you $100 tax rate. Okay, think about that. Think about how, that's basically theft, right? That's you could argue that a thief that comes into your house and steals all your stuff is just charging you 100% tax. But 100% income tax rate, how mad would you be? The reason I bring this up is, sorry about that, I had to clear my throat there. The reason I bring this up is this is the average bond in the United States right now. The average bond in the United States is running at 1.3 to 1.4% yield. Well, inflation is at 2.6%. You're making 1.4% on your bond money, and you're losing 2.6% of your purchasing power each year. That's why I got to do this just for fun. Had this made. That's how I feel about bonds. So I got a few of these if we need a few more, but you're paying double your yield in inflation. and that's money that it's just going down the tubes. Like, to make this clearer, if you're only making 1% and inflation's 2%, you are losing 1% of your wealth in bonds every single year. And it's totally predictable. Like, we know this is your yield. This is inflation. We didn't even have to take taxes out of the yield, which bond interest is taxable. If this is in an IRA, that 1.4% that you're getting in yield, you might only be getting to keep 1 or 1.1 of that after taxes, and you're losing 2.6% of your purchasing power. I mean, it's crazy to me that bonds are a popular thing. It doesn't make any sense, especially in today's inflationary environment. And we're seeing inflation not just on assets too. So this was a really interesting study. I really suggest that if you're into this at all, you go check this one out. This is from the Office of Management and Budget at Bureau of Economic Analysis. So like BEA is what they go by. But they did a study. And you know how they adjust tax brackets each year for inflation? They actually use a lower inflation rate to adjust the tax brackets than what they should be using. It's like a chain versus unchained number that I'm not going to get into for time reasons. But the BEA, the Bureau of Economic Analysis, did this study, and they said that the bracket creep. So again, the fact that their incomes, say, are rising at 3% a year and tax brackets are rising at like 2% a year, it's pushing more and more income up into higher tax brackets. I hope that makes sense. But they estimate that this has cost American taxpayers $1.6 trillion since 1993. Okay, that's just the bracket creep. That's not even talking about the purchasing power you lost due to inflation. That's just the extra taxes that you paid because the tax brackets are not rising as fast as inflation is. So in my book, I have a couple copies somewhere back here, but the new 60/40, this comes from my book. So if you want to see more charts and tables like this, just comment down below, send me the book. We'll get you a copy of the new 60/40. But what I did here is I took a CD interest rate going all the way back to 1965. I then took out a 22% federal income tax rate and a 6% state of Wisconsin state income tax rate. So I took the CD yield minus 28% for taxes, and I compared it to inflation. And guess what? Since 1965, a CD investor has underperformed inflation. So what that basically means is you gave your money to the bank, they went out, made money, loaned it out, made more money, loaned it out, made more money. And over that period, you actually lost wealth. So even though you're getting a credit, you're getting say a 2% interest credit. If inflation's running at 2.6 or 3%, you are going backwards. You are losing money. That's in a CD. Okay. With other vehicles, this is going to look even worse. So I hope on my screen, my face is kind of covering this, but I'm going to hope on your screen that maybe I'm a little bit more off to the side. This is from Robert Shiller, who's an economics professor at Yale. He has this Shiller housing price index. It goes all the way back to 1890. And if you adjust for inflation, the average house appreciation, through the entire history going back to 1890 is like nothing. Like there was the Depression where values went down, and there was the housing bubble on the right when home values went way up and came way back down, as we moved through that bubble and into the housing crash. So like homes, in terms of how they handle inflation, they generally keep up. So I'm gonna do a couple other examples here. We've kind of looked at bonds a little bit. We're gonna dive into them in more detail. CDs don't keep up with inflation. We're gonna talk through gold and a couple other things as well. But homes are basically, I would view a home as like it's probably gonna keep pace with inflation, but that's it. You're not actually like growing your assets. Like don't view the home as an investment. View the home as like purchasing power, maintaining your purchasing power. Kind of going sideways. So I don't know if anyone on this webinar here knows who this is. This is Bill Gross. He is an absolutely so it actually even says that, legendary. He's a legendary bond investor. He says inflation is going to be going to 3 and 4%, and he is short treasuries. So what this means is when bonds go down, he's going to make money. And he has never been short bonds before. His entire career, going back into the 80s, very famous guy, tens of billions of dollars under management. This is the first time ever that he is actively placing bets against the bond market, where he will profit as the bond market falls. And it's because of this. He knows there's a mathematical relationship. So as inflation heats up, so as more money gets pumped into the system by the Federal Reserve and the federal government, government and everything, it's going to lead to higher and higher prices. As prices are rising, bond investors are going to demand higher interest rates. Higher interest rates means bond prices go down. So, because with a bond, your return is fixed. So let's say your return is fixed at 2% a year. Okay, $100 bond pays you $2 a year in interest. If the inflation rate goes up to 3 or 4%, now I might only be willing to pay $90 or $80 for that bond to get that same $2, because there has to be a fair trade for me as a bond investor. If I can go get 4% somewhere else, why would I take 2% on this bond? The bond's return can improve. So what happens is the bond prices fall. And this, again, it's a hard fixed mathematical relationship. JP Morgan's done the math on this. They say for every 1% rise in interest rates, the average 5-year bond will fall 6.6%. The average municipal bond will lose 7%. The average 10-year bond will lose 11.2%. The average corporate bond will lose 11.3%. The average 30-year bond will lose 27%. That's not a typo. This is also not a guess. This is just the math says for every 1% rise in interest rates, bonds are going to get crushed. And again, we're seeing it. So over the last 6 months, if you just go back to the end of November, in this example, what do we got here? We go from, okay, so this is the aggregate bond ETF. This is the average bond in the United States has lost 4% of its value just since like the Thanksgiving timeframe. Okay. And that's because interest rates are going up. Inflation's heating up a little bit. Interest rates are picking up. And already on this tiny little move in interest rates, bonds are already paying the price and really getting crushed. If you own a longer bond, so this is a 6-month chart on treasuries, 20-year treasuries. Believe it or not, they're down 17.5%. They're actually, I reran these numbers today. They're actually down even further because these were kind of older numbers, down like 19% over the last 6 months. It's wild. And it's just because that little bit of interest rate increase is driving down the price that investors are willing to pay for bonds that have poorer yields. And so if you're wondering, well, wait a minute, I own bonds. What does this mean for me going forward? How is inflation going to affect me? Well, we can go back and look, and this table came out of my book, The New 60/40, but we can go back and look from 1950 to 1980. Interest rates went from 2% up to 10%. They actually got all the way up to 16% in 1981. But basically over the longer period there, from 1950 to 1980, you can see interest rates kind of slowly marching up. That's more in line with the path that I think a lot of people are thinking about inflation and interest rates is not like, hey, we're going to be at 20% interest rates next year, but more along the lines of we're going to go from 2 to 4 to 6 to 7, maybe over the course of the next 10 years or 20 years. Well, what's really interesting about this is if you go back and look at these periods when rates were rising, corporate bonds lost 20% of their purchasing power. So this is adjusted for inflation. Government bonds lost 60% of their purchasing power. And again, if you go back to this table, you might have been getting, say, a 2% or a 2.5% interest payment, but inflation was 5%. So you're making 2.5% on your money, but it's not enough. You're actually falling behind every single year. And that's why it's so critical to pay attention to inflation and not own things like bonds that are very, very, very dangerous to own in an inflationary environment. There's a guy named Nick Murray, who's one of my favorite people in the financial planning world. And he says a fixed income in a rising cost world is suicide on the installment plan. And he's not wrong. What he's basically saying is if your prices are going up 2, 3, 4% a year, and your income is staying the same, you are slowly losing income. You're slowly losing wealth, slowly losing lifestyle. Maybe instead of 2 trips a year, maybe you can only do 1 trip a year after 5 years, and it's, you have the same income, but the prices for everything have gone up. So do not own vehicles that are this risky in an inflationary environment. Like bonds to me are riskier than stocks when you look at inflation. And we're going to go through a few different examples yet on stocks. I have some good stuff to cover there, but this is a really, really powerful chart. This is from a book called Stocks for the Long Run, one of my favorite books. But if you get that book and look at this is like on the front cover of the book. And he basically shows, what is this? 1, 2, 3, I'm going to call this 4 different asset classes. So he shows stocks, bonds, bills, which they're basically a shorter term type of bond. And then he shows gold, and then he shows the dollar. So a couple of interesting things here. A dollar invested in the United States dollar in 1800 was still worth a dollar in 1913. So you notice that how it bounces around a little bit, but basically a dollar maintains its purchasing power all the way up to 1913. And then look what happens. The dollar from 1913 to today loses 95% of its purchasing power. Okay, what if instead you took your money and instead of keeping it in cash, what if you put it in gold? Well, your dollar invested back in 1800 has grown to $4. And that's pretty good. That's way better than owning cash, right? And that's even better than a house. We went through the example where a house going all the way back to like 1890, which is kind of in the middle of this graph, has basically gone nowhere over that entire period. Like home values, home appreciation hasn't gone anywhere. Well, gold has actually done a little bit better than that. So that's good. Bonds have done a little bit better than that. But when we start to look at inflationary periods, like from World War II to the 60s, bonds really, really struggle. So across all of these different categories, all these different types of markets, good markets, bad markets, everything in between, stocks have done the best. $1 invested in a stock grew to $705,000. And of course, nobody on here has a 200-year time horizon. So that take that with a little bit of a grain of salt. But what I really want to focus on here is when we start drilling down into these more inflationary periods. So if we look at the entire history of the United States and we say what period out there looks the most like now, I would say the like 60s and 70s, where you had this long period where there was kind of low inflation, low interest rates, and then very quickly we start moving 2, 3, 4, 5, 6, 7% inflation, and then that actually persists for a while. So what I'm going to show you in the next few slides is how a bunch of different investments did over that period. So from 1962 to 1985, all sorts of different things. How did they do? Because this is where the rubber meets the road, as far as if I'm a retirement investor and I'm sitting here going, I think the world is going to be more inflationary. I think taxes are going to potentially go up in the future. Like, what are my options for some of these vehicles that can beat inflation and be tax efficient and leave me in a position where I have more wealth at the end of this period than what I had at the beginning? And it's not to try to like grow it and become Warren Buffett. It's just to try to protect yourself, right? And if inflation was 10%, the only way to stay where you are is to grow your money 10% a year. Okay, so this is a chart from Fidelity. Before I show it, I want to explain kind of what you're looking at. So the bottom, the x-axis here is volatility. So that kind of is like how much these assets are bouncing around, how risky they are. And in general, you want to be as far to the left on this graph as you can be. Like ideally, you'd want to be all the way over where you just own something that just goes up in a straight line and never goes down. And that you can't have that. But that's where you want to be, is to the left on the graph. And then the y-axis there is rate of return. So what that's showing you is the higher you are on this chart, the faster your money's growing. So if your portfolio goes from $100,000 to $110,000, that's a 10% rate of return. So ultimately where we want to be on this chart is up and to the left. We want to be in the top left corner here with the smallest risk we can get with the highest return we can get. And there's a lot on this graph. So like if you want a screenshot of this, just let me know. I'd be happy to share it with you. Again, this isn't my graph. This is Fidelity's graph. But the period here is from 1962 to 1985. And again, it's where you go from this slow inflation rate into a rising inflation rate. And what you'll notice, they put a line on this graph here at about 5.5%. It's the orange line going across the middle of the graph. And that's showing you the inflation rate. Okay, but what they're leaving out of this analysis is a very, very important thing, is taxes. So I would say that you need to make, say, 7 or 8% pre-tax if you're going to beat inflation after taxes. The higher you think taxes are going to be, the more you have to push this dotted line up. So this dotted line here is where I think the real break-even line is, pre-tax. And what you'll notice is a couple different things. So first off, there is a monstrous myth that you want to own commodities in an inflationary environment, and it's just not true. It can actually be kind of dangerous. So if you look at this chart here in the lower right, I don't know what you'd even call that shape, kind of a rectangle type of shape, the cattle, metals, copper, corn, wheat, soybeans. Okay, all of those softer commodities, food type commodities, all those things. Yes, their prices go up, but the cost to produce them go up astronomically. And that's why they actually, in this analysis, they were significantly riskier than a lot of the other stuff out there. So they're down and to the right is a pretty bad spot to be. That's saying more risk and less return. But then also just notice some other things. So I'm going to call out over on the left side here, I circled a few other things. All different types of bonds fit into this box, so that we have the 2-year bond, the 5-year bond, high yield bonds, long-term government bonds, long-term corporate bonds, the 30-year bond, and AAA municipals. All of those things underperform inflation after taxes going through this inflationary environment. So like they are safer from the standpoint of their volatility is on the lower end. They're over on that left side of the graph. That's good. But notice what's to the left of all those bonds. Cash actually did better than most bonds, because remember, as inflation picks up, interest rates go up, bond prices go down. So cash doesn't have any interest rate risk. Okay, when interest rates go up, your cash just gets to make a little bit more. When interest rates go even higher, your cash just gets to make a little bit more. It doesn't trade down when interest rates go up. So that's why you see bonds being significantly riskier than cash, obviously, but also even performing worse than cash. And where things get, I think, very, very powerful to look at here is look at this cloud of stuff. So look at this cloud of stuff like rising off the top of the chart that just did phenomenally well and really isn't that much riskier than bonds. Okay, what's in there? Stocks. Okay, Dow Jones, S&P 500, Europe, oil companies, stocks from other countries, Canada, Spain, Denmark, Sweden, Japan. Large cap value did really well. And if you start getting way up into the top, up there, like the highest thing on the chart is small value. What that means is small companies trading at reasonable prices. That was the best thing to own, was a small business trading at a reasonable price. And notice how they all do relative to gold. So gold is down and to the right on this chart. There's a little rectangle around it. So gold underperformed stocks through this period, and it had more volatility than stocks. And this was a period where we came off the gold standard in 1971. Where like, if I hadn't known all this already, I would have guessed gold was going to be the highest, thing, like top middle of the chart is what I would have guessed. Like up there where small value is, that's where I would have guessed gold was. But actually the stocks did significantly better than the gold. And if you think about it, when you own a stock, you own a business. So a lot of these businesses, if it's a small, growing company with a good idea, they're going to be able to raise their prices faster than what their production costs are rising by. And that's why over this entire period, again, from 1962 to 1985, the best assets to own were stocks. Okay. So where I want to go a little bit further, because I know there's some people on this webinar that have been asking me a lot about hyperinflation. And before we get into that, I'm going to just kind of back up to summarize everything we've been through up to this point. Inflation comes from the supply of money. Okay, the more dollars that are in a system, the less each dollar is worth. Okay, the next point, as inflation picks up, interest rates are going to pick up. Okay, it's going to hurt bonds. Home prices we expect to keep in line with inflation. Gold we expect to keep up with inflation. On this chart over this inflationary period, it did slightly better than inflation. So like if my choices were gold or bonds, I would take gold if we start to see inflation. Homes I would put even below gold. Then I would put cash below homes. And then I would put bonds way, way, way down the list, which is why again I have my favorite shirt on today. But there's a totally other animal that can come along from time to time, and it's called hyperinflation. And I want to be really careful to be clear that I'm not predicting this, so it doesn't mean it can't happen, but I please do not stay up tonight worrying about hyperinflation, because it can actually be not as risky as it appears from the outside, which is going to sound crazy. But first I want to tell a story. So this guy, I don't have his name. I probably could have spent some time and looked it up, but this guy has a pallet full of currency. So this is actually German marks at the time. I'm probably going to mispronounce this. I don't know if it's Weimar or Weimar, but we're going to go with Weimar. So the Weimar Republic, they had a currency crisis right after World War I. And what happened is basically they lost World War I, and the world said, hey, Germany, you got to pay us a bunch of money. So you started this whole thing. We took a vote, we decided you started it. And now the equivalent of this, by the way, is, let's say the United States has $28 trillion in debt right now. It would be the equivalent of the world saying you owe us $40 trillion over the next 20 years. So what are the options there? If you default, you're going to get probably taken over by some other country. So what Germany decided to do was, all right, we're just going to print the money. This is a very German solution. You're going to get your $40 trillion, but it's not going to have the same value. We're going to print it. So this guy in this picture, I don't remember if he was going to buy a loaf of bread or a dozen eggs, but it was something like that. I mean, it took a wheelbarrow full of cash to go, and there's pictures of kids playing with stacks of cash because the parents don't view them as valuable. There's pictures of people burning the money to stay warm, because it was worth more as kindling than it was as marks. But what's really interesting about this is a lot of people look at this and say, hey, if we go into a scenario like this, where let's say the United States prints another $50 trillion over the next 3 years, and the dollar goes absolutely to zero, I want to own, gold and land and those types of things. And I really want to challenge that today, because land prices, first of all, are very, very tied to interest rates. So if we go back and find a piece of property that's been around long enough, we can show you that property lost a significant amount of value back in the 60s and 70s. There was kind of a land bubble, and as interest rates spiked up, land got crushed just like bonds would. So as we're building this hierarchy of what I want to own in inflation, it's businesses up top, reasonably priced businesses. Ideally, I want to own stocks, big, strong companies in the United States, and, some developed markets like maybe the United Kingdom and Japan and Germany and stuff like that. Kind of the next tier down would be some of the lower quality stocks, even like maybe riskier stocks. Next tier down, I would probably say gold. Then I would say a house. Then below that, I would say cash. Below that, I would put land. And below that, I would put bonds. Okay. And it's because land and bonds have that interest rate sensitivity. Whereas interest rates go up, it costs more and more money to buy the same value property, assuming that you're borrowing the money to buy the land. So there starts to become a lot of pressure on land prices. And what's really interesting is if you look at the Weimar Republic, and I have an article for this that I wrote that I was trying to find a cutout of the article, but I still have the data. So I'm just going to go with the data. So from June of 1921 to January of 1924, the mark fell from 75 German marks per dollar to 4.47 billion German marks per dollar. So whatever that is that what, 3 years, 2.5 years, the German mark lost 99.999% of its purchasing power. It basically went to nothing. And a lot of people look at that type of environment and go, man, I don't want to own anything in that country when that's happening. And that's actually not really the best way to look at that. So the Weimar Republic, if you look at that same period from June of 1921 to January of 1924, we're going to look at gold. So if we go back to June of 1921, it took 1,550 marks to buy 1 ounce of gold. Okay, so remember that one, 1,550 marks for 1 ounce of gold. And then January 1924, that person that owned that ounce of gold could trade it back for 92.4 billion German marks. Okay, so that's pretty wild, right? January 1924, your ounce of gold that you paid 1,500 marks for, you now get 92 billion marks for it. So now what we're going to do is we're going to compare another asset class to this. I don't have home value data in the Weimar Republic. I don't have bond data. I don't have land data, but I do have the stock market data. Okay, we can show you the performance of the stock market of the Weimar Republic over this period. And what's really interesting is if you own stocks in the Weimar Republic, so if you took that same 1,550 German marks and instead of buying gold, if you stuck it into the stock market, at the end of the period, you have 124 billion German marks. So remember, gold took you from 1550 to 92 billion. Stocks took you from 1550 to 124 billion. And again, the reason is these businesses don't just shut down. These businesses, I worked for a guy that was taking payment in foreign countries, like in Brazil and Argentina and Russia and some of these places where their currencies were just totally in collapse. He would be taking payment for financial transactions in like pallets of Pepsi and container ships, containers full of Nike shoes and stuff like that. Businesses work around it. They find other ways to do financial transactions so they're not as exposed to the currency. And the businesses outperform, outperform gold, they outperform cash, they outperform home values, they outperform the greatest thing to own is a growing business, and that's where, if you just say, hey, looking at the past, is it going to look like that in the future? We don't know. Nobody can guarantee any of that type of thing, but we want to be diversified. So anyone that's been working with us, they know that we still like the aspect of safety. We still like some cash. We still like bond alternatives, but that ultimately over the long run, if you're worried about inflation, the best way to grow money is by investing with the best businesses in the world. And I said it on my indexing video. If you haven't seen that video of how to outperform 89% of investors, mention down below, say, how do I outperform 89% of investors? We can link you up with that video. If you'd like to learn a little bit more about, bond alternatives that might do a little bit better in rising interest rates, again, you can ask for a copy of my book anytime. Just type in, send me the new 60/40, and we'll get in touch with you about how to get you a copy of this book. But ultimately, at the end of the day, I just want everyone on here to remember that like inflation is real. There's a 2.6% decrease in your wealth coming over the next 12 months. Okay. We know for a fact that there's going to be some kind of inflation. We don't know if it's going to be 2% or 4% or whatever, but let's just pick a number. Let's say it's 3%. That is the bogey we need to chase. Okay. We have to beat 3%. Otherwise you are moving backwards. Okay. So this is Tony with Safeguard Wealth Management, reminding you don't need more money. You need a better plan. You need a plan that can address inflation. And thank you so much for joining us for another Wealth Wednesday. Look forward to seeing you guys all next week. And thanks so much for tuning in and being a part of this group. Take care, guys.